Be watching the markets as we do very closely, but to understand what's been happening in recent times and whether this bear grip that the markets find themselves in, that grip is going to continue or not, let's decode it with our panel of experts. Market experts joining us, Sunil Subramaniam. He's the Managing Director and CEO of Sundaram Mutual. Along with him, we have Mr. A K Prabhakar, the Head of Research at IDBI Capital Market Services. And Sushil Choksey is also with us, Director at Indus Equity Advisors. First to you, Sunil Subramaniam. Tell us about how you're reading the markets right now as they stand. Will this bear grip sustain, you think?
Not really, because I think that this is more an anticipation of the Fed meeting and the expectation of a further one or two interest rate hikes. So I think the market is just a bit uncertain about that, because as you're aware, if the interest rate hike talk is going to be that we are going to go all out to fight inflation and hence don't hesitate to give 2 or 3 more hikes, that could mean that 2-3 things. Because as you know, in the Indian market is actually determined by the net flows from FIIs, the FPIs. So for FPIs, there's a short-term FPIs, which are hedge funds and active MFs, which tends to borrow from the US market and invest into emerging markets like India. So if interest rates are going up, their borrowing costs are going up, then their expected return from the emerging markets likely to go up and hence have some amount of thing. So I think what the Fed comes out from the Jackson Hole conference in terms of their talk about future inflation fighting is very critical. The second thing that it does is that any potential interest rate hike would like to lead to dollar strengthening. And so for FPIs who invest from the advanced countries, there's a risk of the currency weakening for India, and hence they might lose money on the currency also. So that is why there's been this bit of uncertainty the last week, which has led to some choppy FPI flows and led to a market which has been a little bit in a bearish trend. But that being said, as you yourself mentioned, the broader market, the mid-caps and the small cap continue to hold strong because they are driven largely by domestic SIP flows. And those, I think, are holding it up because also remember that the liquidity in the mid and small cap space is lesser. The free float is lesser. So even a small amount of money coming in to buy a few stocks tends to boost up the market prices of those. So I think we are seeing that the domestic economic story is good. Domestic flows are good and hence giving support to the broader market. The larger cap space is naturally a function of FPI outlook. And after today's meeting, once the market gets clarity on the way forward, I think you will see FPI flows coming back to India because the Indian story continues to remain robust and we are among the fastest growing larger economies in the world.
In fact, FPI outflows, that has been a concern for the markets in recent times. But is there more clarity coming in? Because the last time the Fed chair spoke, after the Jackson Hole symposium, the S&P took this massive knock. Today, this is what we heard from the Fed chair at the end of the Jackson Hole symposium. This is the word that they've come out with. As far as their, their action on policy rates are concerned, if inflation remains sticky as it is. In fact, he has said that their restrictive policy will continue until inflation is seen slowing down sustainably. Listen into what the Fed chair said.
Real wage growth has been increasing as inflation has fallen. We expect this labor market rebalancing to continue. Evidence that the tightness in the labor market is no longer easing could also call for a monetary policy response. Turning to the path forward. 2% is and will remain our inflation target. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to that level over time. It is challenging, of course, to know in real time when such a stance has been achieved. There are some challenges that are common to all tightening cycles. For example, real interest rates are now positive and well above mainstream estimates of the neutral policy rate. We see the current stance of policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. But we cannot identify with certainty the neutral rate of interest, and thus there is always uncertainty about the precise level of monetary policy restraint. That assessment is further complicated by uncertainty about the duration of the lags with which monetary tightening affects economic activity and especially inflation. Since the symposium a year ago, the committee has raised the policy rate by 300 basis points, including one.
Well, that's what we got from the Fed chair not too long ago. Mr. Prabhakar, what's your reading of what the Fed chair is saying, what Jerome Powell has said? Because arriving at clarity when it comes to the neutral rate, he says that is still not happening. How are the markets going to take what he says?
This is going to be very negative. Rising interest rate or interest rate stabilizing at current level is something which market is anticipating. So till interest rate cut is not coming, the market will be volatile. But in Indian market, the situation is very different. So there can be a short-term correction, but long-term prospects for the economy is very good. Our rates are very stable. So I don't think that will have a long-term impact. But yes, 1 to 2 months impact could be there due to high interest rate.
Do you agree with that point of view, Sushil Choksey? Because Sunil Subramaniam began by saying that this is the big moment that the markets were waiting for. Now, to see a perceptive kind of change in the market sentiment, going by what the Fed chair has said, because there is no clarity emerging as such. So is that going to be seen as a negative, like Mr. Prabhakar is pointing out? Sushil Choksey?
Good evening and thanks for having me on the show. Mr. Powell's speech is very clear that he is here to fight the inflation and he wants to see a sustainable number which is heading towards 2. Few months of data is positive inclination that the rates can be, but it's not enough to take a decision in that direction. So the dollar index, the 10-year GSEC, the short-term money rates, all are indicated that the Fed, if considers anything, is based on data dependent, and any early action would be visible only in 24 second quarter or the third quarter. And maybe you may be surprised by one more hike coming up in the next meeting. So keeping that in mind, I don't think so interest rates are headed south. In fact, they'll be elevated and they may stay elevated in India too for next 6 to 12 months.
Sunil Subramaniam, do weigh in on this in terms of the RBI action going ahead, because we have moved in tandem with what the Fed has done. And now, like my colleague was reporting, the bank Nifty this week as well has ended up over 0.8%. What's your sense of the financial counters right now, and what do you see favoring upward movements as far as our financials go?
So I think that the financials are in a good space, but from RBI, I don't expect this Jackson Hole statement by Powell to impact the RBI's policy, because I don't think it's clear-cut that there is going to be a rate hike, because I think he said that we'll fight inflation. So as far as RBI is concerned, if you domestically, it's the food prices and the shortage, the monsoon, which is keeping the inflation high, and oil prices have been fairly stable. So from RBI's perspective, I think I will say a pause at the next policy to see whether the Fed follows through on their speak of today, because today is just speak. The next Fed policy will actually demonstrate whether they rise. And RBI, it's the currency management, and RBI has done a brilliant job, because if you see the differential interest rates between India and US are hovering around 3.5% to 4%, and the 1-year depreciation of the rupee has been 3.5%, and the 3-year about 11%. So RBI has managed the currency very well in terms of the fundamentals of the economy, and they would follow through in terms of what the Fed likely to do. But I don't see RBI taking a very strong interest rate hike. Yes, interest rate cut is obviously now pushed back in terms of second quarter of next year, but I don't see RBI doing much. They will keep rates on hold and probably keep monetary tightening as their main goal. So from a financial perspective, I think credit growth is fairly strong. Corporate capex revival is there. And I think the banking and financial space, the deposit growth is lagging the credit growth. So they should be able to pass on any rate hikes to their consumers. And you're seeing housing loans and others, the EMI hikes haven't tapered the demand. This demand is as strong. So I think from a financial perspective, the outlook continues to look good.
Do weigh in on this, Mr. Prabhakar, as well, because there is this one stock, ever since its listing, having been caught in lower circuit, and now only at the end of the week, we've seen that cycle break, but Jio Financial has been in focus. Is there a larger point that we are taking away from how that particular stock has moved in the financial universe?
It is a newly listed company where the business has not started, where ETF fund and index tracking fund has to exit some quantity. any new business, it takes at least 2-3 years for them to stabilize and, say what they will have to do. So now because of Jio listing and Jio Finance listing, there are other financials which will get re-rated. I think, Bajaj Finance is one. There are many companies, which are already in business, which are doing good, and there is a huge space there. So I think we can look at other spaces, but Jio Finance would take time. This is a newly listed stock where the business to start. It is not easy to do a finance, because you need to have a lending franchisee and you need to have a collection franchise. So it takes anyone. We have seen L&T Finance also come in this domain. They struggled and now they have cleaned up their balance sheet. So it takes time. So I won't be in a hurry. I won't look at Jio Finance as a competitor also today. It takes 2-3 years for them to stabilize.
Right. Sunil Subramaniam also kind of pointed out about the kind of traction we are seeing in the broader markets, especially the mid-caps and yes, the small caps after a long gap have joined that party as well. Sushil Choksey, what are the reasons for this, and do you think that kind of traction that we are seeing in the broader markets is going to last as well?
Fundamental changes which have happened, which is led by domestic mutual fund industry, PMS, high net worth individuals who have made enough capital post-COVID in the scenario of the run-up of Nifty. Second thing, the valuation gap between large cap and mid cap had emerged in a big way. And a lot of new funds have come up for small and mid cap funds. Now, the participation of these funds in small caps was very limited, specifically between 2,000 to 10,000 crore market cap companies, and some even larger. Second thing, the entire business cycle of India has changed, led by the direction which the government is taking about infrastructure rollout and employment. If infrastructure starting from building and construction to railways and the PLI schemes which are coming up, starting from electronic to textiles and very many chemicals and things like that. Job creation is a necessity. And the capex cycle is very visible from the government expenditure which is happening on the infrastructure side, and the private capex is likely to take place. And the capacity utilization of some of these industry is at peak, and some needs newer technology and advancement. So the visibility, even from a newer angle like the moon mission today, the success is drawing a lot of attention. What capabilities can emerge? So led by that, capital goods industry, cement industry led by energy cost drop, banking is doing well. One has to see a highlight. You highlighted Union Bank being a drag, but that was because the QIP for a 5,000 crore was priced successful. And if you look at the list of participants, majority of the insurance company are participants, not LIC. So a bank which was not in the radar has raised 5,000 crore of equity, which means the credit growth can be well supported and not that the government had to subscribe equity. So it merits a look rather than thinking that it was drag. It was not a drag. The issue opened on Monday and that led to a fall.
Sunil Subramaniam, you did highlight that the rupee could come under pressure if the dollar now becomes stronger. How is that going to play out on the IT sector? Because there is that kind of demand situation as far as the US market for our IT sector companies are concerned. And also metals. Now, metals, of course, those prices, looking at the kind of slowdown we are seeing in China, looking at their macro picture, that has been a concern. And both these sectors have stayed strong, at least this week. How do you see them performing now?
So I see that essentially in the medium term, if you look at it, I think it's inevitable from what Mr. Powell said that if they're going to fight inflation through a combination of interest rate hike and liquidity, they are going to force the US economy into a slowdown. So I think the only question is the timing of the slowdown, because inflation in a demand-driven economy like US cannot come down without a slowdown happening. Right now, that's still not visible, but the Fed is not going to give up. And bear in mind that next year is an election year in the US. And we all know, right, while growth may win or not win you elections, inflation is certain to lose you elections. So the ruling party there will definitely be putting pressure on the Fed to continue to fight the inflation bear. And from that point of view, I think a slowdown of some sort is inevitable. To that extent, both the metals as well as the IT pack, I would say, would feel some kind of pressure in terms of the business. So I would be cautious on both these. Now, as far as rupee weakening is concerned, I think the key point here is on what RBI thinks is the right level for the rupee. And as you're aware, RBI tracks a 7-country real effective exchange rate and a larger one over medium term. And I think maintaining the balance of the rupee against this 7-country basket is the RBI's main goal. So I don't think from an IT perspective, RBI is going to allow a runaway depreciation of the rupee and for us to get bullish. So I would hedge my bets and stay cautious on both IT and metals at this pace, at this particular point in time, until we get clarity on how the US growth is going to pan out.
Another sector that has been in focus is the power sector. Mr. Prabhakar, what's the road ahead for some of these power stocks?
See, the power growth has been very good, this season. And last month data also is pointing out to a very solid growth. And with, Indian economy improving, I think power is a sector for a long-term people. So I think we are very positive. Tata Power, JSW Energy, NTPC, a few stocks which we like in that space. I think power stock, the rally is here to stay.
Watching all these sectors and how they perform in the week to come. Of course, we've heard the Fed chair, and that's going to have a bearing in these markets. Come Monday, of course, we will be decoding it with our experts as we move along. But for the moment, Sunil Subramaniam, A K Prabhakar and Sushil Choksey, many thanks for joining us with your perspective on this edition of India Tonight.
Thank you.